Welcome to our tutorial, Japanese Candlesticks, Part 1. In this tutorial, we'll be looking at some single candlestick formation patterns and how they can help you identify potential entry and exit points. In a previous tutorial, we explained that there are a number of ways to display price action on charts, with the most popular and widely used being candlestick charts. This is a daily chart of the euro-dollar currency pair, meaning each individual candlestick represents one day of price movement. Candlesticks can be used in any time frame and inform us of the open price, the close price, and the high and low of the instrument we are trading in the time frame selected. The thin lines topping and tailing the candlestick display the high-low range and are called shadows. The top of the upper shadow is the high and the bottom of the lower shadow is the low. So let's start with the basics. Long candlesticks versus short candlesticks. Long green candlesticks show strong buying pressure and a significant move to the upside. The longer the green candlestick, the further the close price is above the open price. This indicates that the prices increased considerably from open to close and buyers were in control during this period. Long red candlesticks show strong selling pressure. The longer the red candlestick, the further the close price is below the open price. This indicates that prices fell considerably from the open to close and the sellers were in control during this period. Candlesticks with short bodies indicate that there was very little buying or selling activity in the time frame selected, or the buyers and the sellers effectively cancelled each other out. We touched on shadows. Let's look at them in more detail. We will start with long shadows. When we see a candlestick with a long upper shadow and a short lower shadow, this indicates that buyers pushed the price higher, but the sellers came back into the market and drove the price back down towards the open price. A long lower shadow and a short upper shadow means that the sellers attempted to push the price lower, but the buyers came back in and pushed the price back up towards the open price. Now let's have a look at some basic single candlestick formations and what they indicate. Spinning tops. Candlesticks with a long upper shadow, a long lower shadow and a small body are called spinning tops. This pattern indicates indecision between buyers and sellers. The small real body indicates little movement from open to close, and the shadows indicate that neither the buyers or sellers gain control of the market in that period. If a spinning top forms during an uptrend, this usually means that there are not many buyers left in the market and a possible reversal in price direction could occur. If the spinning tops form during a downtrend, this usually means that there are not many sellers left in the market and a possible reversal towards the upside could occur. Okay, our next formation is called dojis. Similar to a spinning top, a doji candlestick has the same open and close price, or their bodies are extremely short. They come in a variety of shapes and sizes, but generally mean the same thing, that the market is consolidating, indicating a possible reversal in the current trend. However, when we see dojis, it is important that we look at the preceding and surrounding candlesticks for stronger confirmation of reversal before entering a trade. In this example, we can see a doji candlestick was formed following a downward trend, and it is clear from the preceding candlesticks that the buyers took control and pushed the price up. Our final single candlestick formations are called hammer and hanging man. So let's look at what they are and what they can indicate. The hammer and hanging man look the same but are different in their implication based on the previous price action. Both have long, lower tailing shadows, little to no upper shadow and a small green or red body. Let's look at the hammer first. A hammer is formed after a downtrend and can signify a bullish reversal. The candlestick can have either a red or a green body. In this chart, we see a red hammer formed after a downtrend. The long lower shadow implies that sellers pushed the price down. However, the buyers managed to push the price back up towards the open price, and we see a bullish reversal after the hammer formation. A hanging man is formed after an uptrend and can signify a bearish reversal. The candlestick can also be either red or green. Here we see a green hammer formed after an uptrend. Like the hammer, the next candlestick to form is crucial in deciding whether a reversal is occurring. Therefore, we look for a preceding red, bearish candlestick to develop after the hammer before considering entering a sell position. It is important to remember that you should not look at candlestick formation as your only reason to enter or exit a trade. Always look for additional confirmation using other technical tools. The more confirmation you have, the higher probability of a successful trade. Okay, so what have we learned? Long green candlesticks indicate strong buying pressure. Long red candlesticks indicate strong selling pressure. Candlesticks with short bodies tell us that there was very little buying or selling activity. A spinning top candlestick pattern indicates indecision between buyers and sellers. Dojis generally mean the same thing, that the market is consolidating, indicating a possible reversal in the current trend. A hammer is formed after a downtrend and can signify a bullish reversal. A hanging man is formed after an uptrend and can signify a bearish reversal. Always look at the surrounding candlesticks before making a decision on whether to enter or exit a trade.